All right, good morning, everyone. My name is Kamal, and welcome to the third session of the annuity series. Today, we will talk about the variable annuity. This session is going to be a little bit big, but it will be very interesting for you guys to understand in a lot of detail about various guarantees that will be provided in case of a variable annuity and how it is different from what we have covered so far, that is fixed annuity and fixed index annuity. Okay, so um yeah, let's open this annuity product whiteboard. In the meanwhile, so what we discussed in case of fixed annuity, that you are going to get a guaranteed rate of return on the basis of which you are going to get the accumulation during the accumulation phase. In case of fixed index annuity, we say that you are going to get a return that will be based on a index. Okay, single index or can be a multiple index as well. Then there will be the three different type of strategies that will be applied that will help us in getting the accumulation. What were those three strategies? That were cap rate strategy, participation rate strategy, and the interest rate spread strategy. And we discovered that technically in case of both FA and FIA, your principal is being protected, right? Which means that the downside is completely protected at the 0%. That is, we can see from here. Even if the stock market index will have a return that is negative, but your portfolio return can never be negative. Make sense? Okay. Now we will discuss about the variable annuities. So you see, FA was less risky, less return. FIA was little bit risky, but a little bit more return. VA is very risky, and hence it will provide you with a lot of return. That is what the meaning of, that is one of the feature of the variable annuity is. Okay, so let's try to take a look at some of the features of variable annuity. So it provides you with the option to participate in the market return. So again, this line is pretty much similar to the FIA as well, because in that case also you are getting the returns that will be based on the market rate of return. Now, it offers a range of investment options for you, such as you can invest in the equities, you can invest in the bonds, money market, combination of them, etc. So that is something that separates this from the FIA, in which we covered about that this money is going to be invested in the index. Okay, insurer invest your money into the market index of your choice. Makes sense? Whereas over here, you can invest in the specified equity portfolio, some allocation in that, some allocation in bonds, some part in the money market, etc. Okay, then the insurer will have to charge some of the expenses as well, right? So we are saying that the value of your investment will change daily based on the underlying asset and a fixed deduction of the fund management charges, expense charges, or any other kind of charges. So let's try to create a hypothetical situation. Let's say the age time 0 is equal to 1, then age is, let's say, 40 is equal to this plus 1. Let's get up to this point. So the premium will be paid by the policy holder. Let's say he paid 100,000, right? He just paid a single premium. That is what we are saying. Or he can pay regular premium as well during the accumulation phase from 40 to 65. Let's say in our example, let's say he just paid a single premium, $100,000. Now, out of this premium, some part of the premium will be deducted for the expenses and all other charges, right? Expense and other or we call it, let's say, E and OC. Let's call it just that, or just call it charges. Expense. So let's say this is just 1% of this value, right? So what will be the premium left? Premium allocated, call it this. That will be this minus this. So now we have to decide. I mean, the policyholder has to decide that in what proportion he wants to invest in the different sub account. Let's say sub account one. AV at end of period. Let's try to do something like this. Okay. So premium allocated is this. So let's say this sub account one is basically mean investing in the equity. This sub account two means being invested into the bonds, and sub account three means investing in the money market. Let's call it this way, that this money is being invested in equities. This money will be invested in this one will be in, let's say, money market, and this one will be in bonds. That is what we are saying. So let's say I want to allocate 40% in equities, 40% in bonds, and 20% in money market. My premium that is ready to be invested in these different sub funds is this 99,000. I will allocate over here. I will have to put the return that I will be achieving. Let's say in the first year, the return in the equities are 10%, in the bonds are, let's say, 4%, in the money market is, let's say, 2%. So what will be the value at the end of the period? Simply, what is my allocation for equities first of all? That is this into this value, correct? I will make it like this, right? So this is the allocation for this, and for this, the return I get is 1 plus I, correct? That is the return I get for this one, okay? Plus this balance, allocation of bonds, allocation in bonds is this. Increase this cell into 1 plus I, that is this, correct? Plus the remaining allocation, that will be this into the 20%. Okay, in this one will be 1 plus. So that is the accumulated balance at the end of the period based on different sub accounts in which my money has been invested. Correct? Next year, what will happen? Like, this is a single premium in our example, although you can have a regular premium as well. So now what happened next year is that your balance at the end of the period will become at the beginning of the period over here, correct? And let's say, let's, you know what, let's do something like this. Premium allocated AV at beginning of period. Okay. Just give me a second. Let's see how we can do that. Suppose now this is the value at the end of the period, and I am applying, let's say, fund management charges. Okay. Now what happened next year is, let's say the balance is now this, correct? Now there are the fund management charges that will be applied. Let's say that is just 1%, 0.01. Or let's put it over there. FMC charges, that will be 1%. Okay. So this is the balance that I have, and this is the. So what will be my remaining account value balance at the beginning of the period? That is this balance that is ready to be invested. Correct. So again, let's say next year the returns are pretty much, let's say 1% more return. It is again, let's say 11% return, 6% return, 3% return. Just take an example. So you see, yeah, the formulas are going on correctly. So 103 was the beginning. Then I get a lot of return, positive return in these different sub accounts, and that is my account value at the end of the year. We'll reach this cell. So now let's say if I project this thing, and now let's say over here I get minus 5%. Okay, in bonds I get 2%. In money market, let's say this. So if you see over here carefully, the account value that was there at the beginning of the period was 110,000 and something. But at the end of the period, this value has been reduced to 109,000. If you see carefully over there, it has been reduced to 109. Whereas this was not the case in case of fixed index annuity, because we are saying that you are going to get a full protection value of your principal amount in both FA and FIA. But this concept does not apply in case of a in case of a variable annuity. And that makes sense, right? Because you are going to get a huge exposure to the upside potential in terms of the return based on market. So obviously you going to have consequences in terms of the risk as well when there will be the negative returns. And that risk will be reflected in your account value balance. Okay, so that is what we are trying to say in this case. I hope this is clear, right? So value of your investment will be changed daily based on the underlying asset and the fixed deduction of the FMC, fund management charge, expense charges, etc. In our example, we just consider it like on an annual basis, correct? Let's move forward. Variable annuity offers a range of different living benefits and death benefit as riders, which provides you with the downside protection for an additional fees. Like as of right now, the downside potential is completely exposed. So when I use the word downside potential, I mean like the premium amount, let's say whatever you have invested, that can even go, I mean, less, right? Let's say you invested $100 and at the end of the year, it may be, let's say $95 because you are going to get a negative return in the market, which will be reflected in your account value as well. Okay. So it means that your downside is also being exposed. Whereas earlier, in case of FA and FIA, your downside was protected. Correct? So, considering this situation, the variable annuity provides you with a lot of different types of guarantees, which comes in the form of riders. There are five guarantees that we will talk about: GMDB, guaranteed minimum death benefit, guaranteed minimum accumulation benefit, guaranteed minimum withdrawal benefit, guaranteed minimum income benefit, and guaranteed life withdrawal benefit. We will cover about all these five of them later on. Let's move forward for now. So it has a potential for higher return, makes sense, which we can see. And again, there is a tax deferred growth, but unlike the fixed annuity, it can lose money. Basically, the return, if the return will be negative, your account value balance can also be negative. You are not going to get the full principal protection. Make sense? And again, tax deferred growth, which makes sense, right? Like this accumulation in your balance is not going to be taxed. It is only going to be taxed at the time of withdrawal. So hence we are saying that it is a tax deferred. So this is like an advantage, you can say. Return on variable annuity depends upon the underlying investment performance, which we can see. The performance of this equity basket is this that will be reflected in your account value. Same with the bonds and the money market. Make sense? Let's move on. VA typically provides a different range of investment options, and we call it sub accounts that may include stocks, bonds, money market, or a combination of them. Provides various sub accounts that can be stocks, bonds, money market, or a combination of them. Make sense? Moving on. In exchange of a lump sum or a regular premium, you can get a future lump sum cash amount or a series of payout, or it can be a certain number of years, for certain number of years, or for lifetime. Which technically this is the same thing that applies in all types of annuity, whether it is FA, FIA, or VA. What we are saying is that as a policy holder, it's all up to you, man, that during the accumulation phase, how do you want to pay the premium? I'm saying that okay, you can pay just a single premium, or you can pay the regular premiums. Same concept with the FA and FIA as well. During the income phase, during the payout phase, you it's all up to you that whether you want to just take out that complete amount as a lump sum amount, or you want to convert that balance whatever be at the end of the accumulation phase in terms of an annuity. It's all up to you, right? So that is what we are trying to say. Let's see if I project this. Simply be like this. Okay. I'm just assuming in this example that there are only FMC, like the fund management charge, that will be applied, which is 1%. Whereas there are other charges also, right, that will be applied. Okay, moving on. The variety of fees and expenses will be applied, such as 3 to 4% more expenses will be charged, like which this 3 to 4% that will be applied consist of like the your mortality and expense charges, administrative fees, investment management fees, which is your fund management charge, and the surrender charges. Surrender charges means, let's say if you withdraw like right now at this age, so there will be a surrender penalty as well, which can be as high as 10%. I think in the regulation for the variable annuity in the US, they say that if that the surrender penalty will not be applied if you withdraw after the age of 59.5. So when you are 59 years and 6 months old, okay, and obviously there is a condition of minimum number of years that you have spent during the accumulation phase. And if those two conditions are met, then the surrender penalty will not be applied. Okay, or the even the federal tax penalty sometimes will be applied. So those things are pretty much a regulatory aspect. Let's not get into that. For now, let's understand that the surrender penalty can also be applied. Make sense? Moving on, withdrawal from VA starts from age 59.5. If you withdraw before this age, it is subject to a surrender penalty, or you call it the withdrawal penalty, which may be up to 10%. So that is what we have discussed. What are the pros and cons of this type of product, which is this variable annuity? Let's take a look. So possible inflation hedge, which makes sense. Like if the inflation is high, then your returns within the equity may be high, or the in the bonds it may provide you with the good return as well, right? Even in the money markets as well, it can provide you with the good returns. So it is a good inflation hedge, we can say. Initial investment protection. See over here, initial investment protection. So again, this can be dependent upon the what should I say, dependent upon the rider. So the variable annuity will comes up with a different riders that we will discuss after these pros and cons, and we will touch upon this point at that point of time. A death benefit can also be provided during the accumulation phase. Payment can be provided for lifetime, and the tax deferred growth. Makes sense. Cons will be the complexity. It is sometimes very much complex to model this product for actuaries. There is not any kind of guaranteed return, and it will be taxed as income when you get that. Surrender charges are very high. The fees that will be charged, that is like 3 to 4% per year, is also pretty much high, right? So these are the cons, or you can say the limitations, disadvantages, same thing. Okay, now let's talk about different type of riders that we are talking about. GMDB, guaranteed minimum death benefit. Guaranteed minimum death benefit. So let's take a look what exactly is this. So it offers you a guaranteed value, sum assured kind of thing on death. This GMDB can be simple, such as offering a minimum of return of premium, or the premium being rolled up at a preset interest rate, or it can offer you a minimum guarantee of the highest point the fund has ever reached, or the average fund value on the last few anniversaries. Technically, what we are trying to say is, let's say this is your account value. If during the accumulation phase the policyholder is gonna die, let's say, so what happened in that case, that whatever be the account value balance that exists at that point of time, let's say at this point, the mortality occur. So as an insurer will provide that account value to the beneficiary of the contract holder. This can be one of the thing. And let's say, for example, that the mortality occurs over here. Just taking an example, okay? So what we are saying, that in this case, the amount that will be provided, will be the highest that the fund has ever reached. So what was the highest value that the fund has ever reached? That is 101 comma 579. Like, this is the amount that the fund has ever reached up to this point. So insurer can provide this much amount of money, or insurer can provide just a return of premium if, let's say, the values are even less than 100,000. So in case of a death, mortality, insurer can provide the return of premium as well, or the insurer can provide a return of premium that is being accumulated at a pre-specified rate of return. Let's say allocation, for example, let's say pre-specified rate of return is 2% into 1.02. So this one into 1.02. So let's say if there is a death, let's say this year the return is minus 10%, 1%, 1%. Okay, same with this year. So now if you see this example, in this example, we can see the account value is already very less, but we are providing the GMDB in the form that we will provide you with the return of premium that will be accumulated preset interest rate, like premium rolled up at a preset interest rate, which we are considering it as 2%, right? So we will provide the beneficiary of the contract holder with the this much amount of money. Okay, so it depends upon a contract to contract. There cannot be just a single feature within the GMDB. What we are trying to say is that there can be some kind of guarantee that will be provided in case of a death of a contract holder. There are various types through which the insurer can provide that can be such as account value that exists at that point of time, okay, with the minimum amount that will be paid is the premium that is paid at the beginning of the year, or just a return of premium, or the return of premium that is being allocated based on the preset interest rate, which in our example we used is 2%. Correct. Now let's move on to the second rider, that is GMAB. Okay, so now let's take a look at the second rider, that is GMAB, guaranteed minimum accumulation benefit. So one of the feature is exactly similar to the GMDB, that is it will offer a minimum of the premium being rolled up at a preset interest rate. So which is basically this thing, 102,000. Let's say what happened was that during the first year, the returns are like this, right? Minus 5%, 1%, 3%. But we have a GMAB type of guarantee. Okay, GMAB type of guarantee in which we are saying that the minimum allocation will be the 2%, right? So even if your return is negative, you are going to get the accumulation on the basis of this 102,000. But what has to be considered in this point is sometimes that, for example, okay, let's say over here the return is minus 12%, 1%, 1%, minus 50%, let's say just minus 80%. Not possible. Just give me a second. Okay, let's say that during the last years, the returns are minus 50, minus 50, and so on in the equity side. So what happened due to that? That the account value balance comes out to be just 90,000. But we have a guarantee of GMAB, accumulation benefit, in which the minimum accumulation will be a 2% based on the premium that you have invested. So using that, the value comes out to be 167,000. This is the amount of balance that will be considered then, not this balance. Okay, so this is the benefit, the beauty of GMAB, correct? There can be the more complex guarantees also that could have ever highest value that has ever reached. So in these different years, whatever be the highest value that has ever reached, that is the amount of balance that will be provided. For example, highest value what has ever reached is maximum of these balances, and it comes out to be this 248,000. So then this is the amount of balance that will be provided. So that is what we are trying to say. Okay. Or more common feature of a GMAB is a ratchet whereby the guarantee increases each year by the larger of a proportion of fund actual return and the guaranteed minimum amount. Now this is a pretty amazing type of guarantee accumulation. So for example, in the first year, simply the return was negative and our account value at the end of the period is 97,614. But the minimum accumulation benefit comes out to be 102,000. So next year, your balance, your balance will be considered as the maximum of these two. What was the maximum? That is the 102. So I am saying that okay, maximum of these two balance. So I will consider that as my beginning balance. And then on the basis of that, I will get the accumulation. So you see, if I use this concept, the account value at the end of the period comes out to be 108,000. If I don't use this concept, you can see it is 103,000 and something. Okay, so that is what we are trying to say. That in this case, we will consider the highest value between both of them every single year, right? Whereby the guarantee increases each year by the larger of, that is the maximum of, the fund's actual return and the guaranteed minimum return. Make sense? Good. Now let's move on to the next guarantee, that is guaranteed minimum income benefit. Now this is something, okay, this is something that is based on from the payout phase. Okay, now that is something we have to consider at the payout phase. So let's do it like this. Okay, so let's say we are going to consider this as the balance in the at the age of 65, right? So now we are saying that we will consider this balance, then we will provide you with the annuity based on that for lifetime. So what happens is it guarantees you with the minimum monthly annuity payment and it will not be affected by the market performance. The income levels are guaranteed at the beginning or at outset, same thing, on a minimum conversion rates regardless of the movements in the financial and mortality markets. These benefits are typically targeted at the retirement markets, but this guarantee is contingent on a condition of contract holder choosing to annuitize their account value rather than withdrawing as lump sum amount. Let's understand. This is the value that exists at the age of 65. So now we are saying that if you want GMIB, guaranteed minimum income benefit, then you are not allowed to withdraw this amount as a lump sum, you are going to get the annuity. Okay. For example, so it is also mentioned that this is a guarantee which is being fixed at the time of issue of the contract. Okay, at the time of issue of the contract. Let's say at the time of issue of the contract, we say that whatever be the guarantee that we will provide you the guarantee in such a way that whatever be the account value that exists, then we will provide you with the annuity of, let's say, $5. Okay, $5 for every $100. Okay, technically it is in terms of the interest rate. Let's say I will say that, okay, I will provide you with the guarantee based on 3%. Okay, but at the age of 65, let's say the return interest rate in the market is very very low. Let's say the interest rate in the market is just 1%. So what happen in that case, that your annuity amount is comes out to be very less. But I am saying that whatever be the interest rates prevailing in the market at the age of 65 for you, contract holder, I will provide you with the minimum interest rate of 3% in terms of annuity. Okay. I'm just converting that 3% in terms of the annuity payment. Just a random thing that, okay, it comes out to be, let's say, $5 for every $100 that you have invested. Okay. So for I'm going to give you the $5 for every $100 invested. So it comes out to be is equal to 5 by 100. Technically, this is the so this 5% something I will provide you. Just taking an example over here. Basically, the 1/20th of what I am going to give you. So over here is basically then, let's say, this divided by 20th. So this will be the annuity that I will provide you for the lifetime. So basically, if let's say if this guarantee does not exist of GMIB, and the interest rates prevailing in the market is, let's say, 1%, and just taking a random thing that it might comes out to be that return that will be provided will be just $3 for every $100 balance. So which means like 3 divided by 100, 3%. So then that comes out to be this into this. So you see that if that guarantee does not exist, then in that case it might comes out to be a very less annuity amount for you. But if the return interest rate prevailing in the market at that point of time is, let's say, 5%, which is so huge, which is more than the minimum guarantee that we were providing, that is 3%, that is fine. If let's say 5% is going on, which simply means like for every $100 invested, we will give you, let's say, some kind of $7 for every $100. Just taking a random thing. So in that case, it comes out to be what, 0.07. So this is the balance that exists into this. So you see, this is the amount of annuity then I will provide you based on your balance that is there at that point of time. Make sense? So it is like this only. Now you may say that how this thing is coming up, $5 for every $100. This 3% example, actually this is more like the annuity concept that is covered in your I think CT1 or CM1. So I'm not going to get into those details. I will tell you, let's just forget about this 3% kind of thing. We are saying that just consider this thing, that for every $100 balance we will provide you with the $5 annuity every year for the rest of your life. But what happened at the age of 65, that the in the market the returns that will be provided is such a way that for every $100 invested, $7 will be provided every year in terms of annuity. So obviously then I will use this guarantee, this type of thing. But if the conditions are so poor that in the market returns that will be provided is just $3 for every $100 amount. Okay. So I am happy to have this kind of guarantee, then that at least I am getting a $5 for every $100 balance. So you see, That is how it is getting beneficial. So this is GMIB. Next is guaranteed minimum withdrawal benefit. So what happened? So if you remember that in GMIB we covered about one shortcoming, one disadvantage, that you cannot withdraw the balance. Right? We are saying that you cannot withdraw the balance. The entire thing that you are going to get will be in a form of the annuity. In case of GMW, so yeah, the shortcoming is in GMIB is that you cannot surrender the contract and cannot receive the death benefit if the payment has started. We all know that. But this shortcoming is being addressed by the GMWB. It guarantees you the minimum withdrawal benefit, which is the certain percentage of a base value after an initial waiting period is over, which can be, let's say, 10 years after the policy issue date or the attained age of 59.5. This benefit base is different and calculated separately from the account value. Withdrawals will continue until the benefit reaches zero. Okay, until the benefit reaches zero. So, what exactly is this? Let's try to understand. Let's say this is the balance that has been reached in our account value. We are saying that, okay, we will provide you the 5% of this balance minimum every year, that you can withdraw the minimum 5% of the value out of this balance. That is what we are saying. And if, and whatever be the remaining balance, that will keep on accumulating the return, but every year minimum 5% of this specific balance, of this balance, you can withdraw. And whatever, if you want to withdraw more than that, you can, but then on the basis of that, this balance will keep on reducing. But the minimum we can provide you with the 5%. But that is for a specified period of years. Guaranteed minimum withdrawal benefit, let's say for, let's say you, we are saying that you can withdraw, let's say, um 7% every year for the next 15 years you can withdraw, right? But there is one more concept in which, that is the GLWB, guaranteed life withdrawal benefit. It is similar to the GMWB, but here we are saying that the withdrawals will continue even after the benefit base reaches zero, but it can be withdraw up to the death of the policyholder. So you can withdraw as much balance as you want. I mean, the minimum balance that you can withdraw for your lifetime. But there is a catch in these things. Let's understand that. But before that, let's understand the concept of this benefit base we are trying to say so many times. Yeah, this thing, this benefit base we are saying. So what we are saying is that, just take an example, that every year the balance will be considered. Let's say, let's try to understand this benefit base using these concepts. So common benefit based design is, let's say, roll up, where the benefit base will increases at a contractual rate, let's say 5%. That can be simple rate of return or a compounded. Let's say it is compounded 5%. Okay, let's do this. The benefit base at the rate of 5%. So the balance was this, 1.05, this into 0.05. Okay, so we're just giving you with the 5% accumulation. Let's say over here the balance will be, I mean, yeah, this is the balance of the benefit base. This is a different balance. Yeah, okay, 355,000 is the benefit base, whereas my account value was 329,000. I am saying under the GMWB, that I will provide you with the 7% return for the next 15 years. So what will be that? That is of this benefit based balance into the 7%. So this balance you can withdraw, okay, every year for the next 15 years. Okay. Minimum withdrawal. So what will be the account value after withdrawal? Let's do it like in this manner. So let's say, let's try to, not do it over here. Let me just clean it up. Let's do it over here. GMWB. So what was the benefit base? It comes out to be this balance, correct? And the account value comes out to be this balance. Okay. So BB, that is benefit base, the AV, account value. Okay. And or maybe let's do it like year return earned age, let's say 66. 66 plus 1 and so on. Okay, return earned. Fund before withdrawal. Withdrawal amount. Fund after withdrawal. Okay. Benefit base remaining. Now let's understand this beautifully. Okay, we just created this small chart over here. So what will be the withdrawal amount? That will be the 7%. Let's say we are saying it is the 7% that you will get for the next 15 years. 15 into 7 is this. So it's a good deal, you can say, more than 100. Withdrawal amount. This is the benefit base into the withdrawal amount. That is the minimum withdrawal that you can get. You can withdraw even more than that if you want to, but there is a catch in that. So every year you can withdraw this much amount of balance for the next 15 years. And the sum that you will withdraw is 373,000 something, whereas your benefit base is 355. Just the account value is even 329. Let's say in the first year, in the income phase out, the return that you achieved was 9%. What was the fund? Fund over here, he means the account value. What was the account value before withdrawal? That is this. Then you withdraw this much amount of money. Correct? Fund before withdrawal. That was actually this into 1 plus I, because then you achieve the return on this balance as well. Then you withdraw this much amount of balance. What was the fund after withdrawal? That is this minus this. So that is the fund account value that is remaining. By fund I mean the EV. So now next is the what is the benefit base that is remaining. Benefit base was this minus this, correct? Now let's say what happened next year is the return is minus 10%. So what will be the fund value now? Fund value, that was this into 1 plus I, that is this. Okay. So what is the fund value remaining is this minus this. What is the benefit base that is remaining is this minus this. Correct? Every year it will be keep on reducing in such a way. So similarly, let's say next year the returns is minus 60%, minus 20%, or let's say just 20%, then minus 50%. Let's see what will happen in this case. Okay. Now there is a situation in this case. During the income phase, the returns were pretty much negative. Okay. Which has an impact on your account value. What happened during the sixth year at the age of 71? That the fund value before withdrawing the amount for that year, but the return was minus 50%, due to which your account value balance remaining was only 7,000. Whereas, as per the guaranteed minimum withdrawal benefit, your annuity amount that you have to withdraw is 24,889. So, how will you get that money? So, as long as your benefit base is positive, I repeat, as long as your benefit base is positive, you will keep on getting your withdrawal amount. When this benefit base amount will get depleted to zero, that is at this stage, we can see that the benefit base remaining was just 7,000. So we can just pay 7,000 at that point of time and then just close the policy. As long as your benefit base is positive, the person is going to receive his or her withdrawal amount. The moment with BB is going to get exhausted, the policy will be closed. If at that point of time the account value still exists, then we will pay that just small amount of money that will be left. Again, it depends upon a policy to policy. In technical terms, if this account value will get exhausted, I don't care, because I am getting a minimum withdrawal benefit guarantee. So that will be exhausted at the end of 15th year. That we can see simple clearly. So that is what the meaning of guaranteed minimum withdrawal benefit. But you can get, but there is a catch, which is in the form of a new rider, that is GLWB, guaranteed life withdrawal benefit. It works like GMWB, but here the withdrawals will continue even after the benefit base reaches zero, up to the death of policyholder. That even if we can see that the BB, the benefit base has been, the benefit base is now less than zero, is technically negative. I don't care. The person is going to receive this much amount of money every year as long as he is alive. That is what the meaning of GLWB. Okay. So I hope that you are able to understand. I know it is pretty much technical, but it is super amazing. You can watch this video again if you want to understand. We covered about GMAB, we covered about GMIB, then we covered about GMDB, then in the end we covered about GMWB, followed by GLWB as well. So we covered about the roll up concept in case of benefit base. Next is the ratchet, or we call it step up, that we have seen over here in GMAB as well, about the ratchet, where we were saying that in, let's say in this 2 year, but whichever has the highest value, we will consider that as my benefit base. So that will be like 102,000. In this year it will be 104,000. Okay, minimum 102, then that will be minimum balance. So this balance cannot be reduced. So that is how that ratchet will work. Okay, the last benefit base is just the return of premium, that minimum, just the premium amount that you have invested, that will be the minimum benefit base. Otherwise, if your account value is higher than this balance, so then that will become technically your benefit base. Okay, so I know it is a little bit complex, but it contains a lot of details. Just keep your mindset pretty much simple, that in case of a VA, the returns can be negative as well, but you can protect your negative using the riders that will be available. Okay, and the exposure to the market is pretty much high. That is why you can get even a higher rate of return as well. Whereas in case of fixed index annuity, your initial principal amount will be protected, but you can get a higher return based on the single index or the multiple index. In case of fixed annuity, it is just the guaranteed allocated return that will be provided. Okay, so with this, we're done with our variable annuity as well. So if you like this course, you can definitely check out the other courses on the actuarysense.com, that is Python for Actuaries and the SQL for Actuaries. With this, thank you so much, and I will see you in the next lecture.